British American Tobacco balance sheet up in smoke. For over 100 years, British American Tobacco has been the leading brand in cigarettes. But now, as smoking declines, BAT is betting on a bold new future. What are they doing? Well, it starts with them writing down about a quarter of their asset value on their balance sheet. But more on that in just a bit. Welcome to this Valuation Masterclass case study. My name is Andrew Stotts. Remember, you can click the link in the description to grab my top 500 global companies cheat sheet. In this video, you're going to learn British Tobacco, American Tobacco's response to falling smoking rates and assess the effectiveness of British American Tobacco's competitive advantage and evaluate BAT's potential using my cheat sheet for assessing any stock's attractiveness. And remember, you can get that cheat sheet and this presentation for free by clicking on the link in the description. So let's talk about this company's background. It's a leading name in the global nicotine industry. BAT is one of the world's largest producers of tobacco and nicotine products. It operates in over 180 countries with a portfolio of traditional tobacco products and newer reduced risk products. It holds the second largest global market share, which is 21% in the industry. It's incredible. Nicotine is, of course, a highly addictive chemical present in tobacco leaves. Nicotine triggers the release of dopamine, which is, of course, a feel-good chemical, creating feelings of pleasure and relaxation. Over time, the brain adapts, requiring larger doses to achieve the same effects, creating a cycle of craving and use. British American Tobacco generates billions by innovating and diversifying nicotine products. 81% of revenues come from combustibles, that's cigarettes and cigars that release nicotine through burning them, as is most common. 12% of revenue comes from new products like vapor, e-cigarettes, which heat liquid to produce nicotine vapor, and also heated products, which heat rather than burn tobacco to get nicotine. And then finally, there's the modern orals, meaning tobacco-free nicotine pouches that you put in your mouth. 5% come from traditional orals, which is what we know as basically chewing tobacco. And it's made from fermented or processed tobacco leaves, inhaled or snorted. Now, there's a strong U.S. premium demand and combustible growth in Japan, Korea, and the Middle East. Let's look at the revenue of the company. 43% of revenue of BAT is coming from the United States, 35% from the rest of America and Europe, and 20% from Asia Pacific, Middle East, and Africa. So in 1902, BAT was formed as a JV between Imperial Tobacco, which was in the UK, and American Tobacco in the US. And this stopped each of them from competing in their respective markets. So together, that JV attacked the world, going after selling tobacco around the world. But it didn't last for long. In 1907, the US government charged American Tobacco Company with being a monopoly. And in 1911, the Supreme Court dissolved American Tobacco for monopolistic practices. And American Tobacco was forced to divest its BAT shares, making BAT an independent company. Now, American Tobacco was also forced to sell its shares in R.J. Reynolds after this 1911 judgment. R.J. Reynolds is an interesting company. It's going to come back as I go through this story. But it was started by a guy named Richard Joshua Reynolds, which he founded R.J. Reynolds in 1875. And part of the monopoly charge against the company of American Tobacco was that it was forcing companies to sell to him. And so this guy, Richard Joshua Reynolds, had to sell his R.J. Reynolds in 1899 to American Tobacco. Now, after gaining independence in 1911, R.J. Reynolds basically introduced Camels, revolutionizing the market. Now, Camels were the first cigarettes that was a blended cigarettes of different tobaccos, which made it smoother. It was lower cost, it was convenient, and it was marketed for mass appeal. In 1954, R.J. Reynolds launched Winston's, which was the first filtered tip cigarette. In 1989, I remember when I was a young guy that it merged with Nabisco to form RJR Nabisco, but 10 years later it split in 1999. And in 1999, Brown and Williamson merged with R.J. Reynolds to form Reynolds American Inc., which is also called RAI. And BAT retained a 42% stake in the company then at 1999. Now, in 2004, BAT privatized an Italian tobacco company called ETI, which made it the largest provider of tobacco products in Europe. And in 2017, BAT bought the remaining 58% of Reynolds American and gained full ownership. This meant the company was the largest listed tobacco company in the world. And today, of course, Reynolds American operates under BAT. In 2020, they invested in reduced risk products like vaping and nicotine pouches. And this shift reflects BAT's commitment to consumer health and responding to the evolving preferences of adult nicotine users. Of course, for people like me who don't use nicotine, I would say the company's definitely evolving, and smoking is much more dangerous than the other ways, but still, it's nicotine. So let's talk about British American Tobacco's response to falling smoking rates. People don't smoke as much anymore. In fact, what we can see is that like all cigarette makers, British American Tobacco is facing major challenges. Its core product to cigarettes is in a long-term decline. In fact, this particular chart shows that U.S. cigarette sales went down from 1981, about 636 billion cigarettes sold per year, down to 173 billion cigarettes sold. So that's a 72% decline up until 2022. That's a major decline. In fact, as an investor, you really don't want to invest in an industry that's just in decline. It's so hard to make money, but maybe that decline is over. So what's BAT's response? Well, they acknowledged this challenge with a significant impairment charge in 2023. And this goes back to the title when I was saying that they wrote down a portion of their balance sheet, Up in Smoke. What they did is they wrote down the value of its U.S. operations. They also decided to amortize their U.S. cigarette brands over no more than 30 years, signaling uncertainty about the long-term viability. Let's take a look at this in a little bit more detail. Basically, at the end of 2023, BAT took a 27 billion pound charge that reduced total assets by 23%. Can you imagine knocking off 23% of the asset value of a business? Now, later, I'm going to talk to you about how this impacts the price to book value. But for right now, let's understand what they did. 41% of this 27 billion charge, so nearly half, was an 11 billion pound write-off of its Newport brand. Remember, Newport has menthols, and the attack is on menthols. So they basically said there's not that much value in those Newport brand. 21% of this 27 billion charge was about 5.7 billion hit to the Camel brand, where they also wrote down the value of that brand. 16% came from about a 4 billion pound charge or write down of Reynolds American goodwill, which they had written up when they bought it. And finally, 13% of that was a write down of Pall Mall cigarettes. So what you can see here is that the company is getting really aggressive and saying, we don't think there's a lot of value in these old brands. We had them on our balance sheet, but we're not going to value them as much. So, and most of this is happening because they're getting so much pressure from governments. I'm going to also talk about that in just a second, but BAT's future lies in its new categories division. A growing number of adult smokers are transitioning to smokeless alternatives like vaping products or heated or the oral products. And British American Tobacco has played a key role in this industry transformation through its multi-category strategy designed to meet the evolving preferences of these consumers. BAT's three leading smokeless brands have generated over $3 billion in revenue within a decade. The first one is Vuse, and the second one is Glow, and the third one is Velo. So BAT is committed to building a smokeless world by encouraging smokers to switch to smokeless alternatives. Now you may think to yourself, a smokeless world, okay, not bad, but they're not producing a world without nicotine, of course. These products face significant scrutiny regarding their safety. So governments are imposing strict regulations like flavor bans and like menthol bans, which could affect Newport brand cigarettes, packaging rules, and high taxes on nicotine. Obviously, governments don't want to support nicotine. They want to penalize them or produce a sin tax on these. BAT faces rising competition from gray market sales, especially in the US and EU, where illegal vapes and counterfeits undermine growth. And traditional tobacco products enjoy strong brand loyalty built over decades, but new categories lack this loyalty. So to recap the company's background, British American Tobacco remains heavily reliant on its combustible products, and it is investing to build a smokeless future, and the transition remains gradual with sticky customers. So what is the company's competitive advantage? Well, we got 46,000 companies in this, employees in this company, and its main divisions are, of course, the new categories like the vapes and stuff, the traditional oils, and then orals, and then the combustibles. So the competitive advantage of this company has happened through strong brand portfolio and geographic diversification across the world, and regulatory pricing power, and of course innovation now, as we see in vaping and the like. And it's achieved by transitioning a dual product company in traditional and new categories, and trying to do addiction driven customer loyalty, of course, whether that's sugar at Pepsi or Coke, or whether that's caffeine at Starbucks. We know that there is an addiction factor there. So BAT leverages its cigarette brands to maintain market dominance and strong cash flows, while also investing heavily in reduced risk products to meet evolving consumer demand and regulatory trends. They're caught in the middle. The regulators are after their business. Iconic brands like Dunhill, Lucky Strike, and Pall Mall enjoy strong customer loyalty. BAT invests in targeted marketing campaigns, especially for these premium and also innovative products, to try to sustain their brand equity. BAT's strong brand image lets it increase prices for premium products. For instance, what we can see is that actually revenue has been pretty flat over the last few years, but they managed to increase the profitability by price increases, as well as changing the mix. So volume actually dropped by 7%, but because they switched more into high margin products, they were able to get a 4% increase. Now in the UK, following a government duty hike in 2024, BAT adjusted prices, pushing the cost of a 20-pack cigarette pack to 17 pounds from 15. Clearly, governments do not want this at all. But let me tell you, they got a sustainability vision of a better tomorrow. They're building a smokeless world, and that's what they call it. BAT emphasizes environmental and social responsibility, aiming for carbon neutrality across operations by 2030. But let me ask you, how do you think about that? So on the one hand, they're making products that are addictive and potentially dangerous, but on the other hand, they're telling you that they have a sustainability vision. In fact, they're an ESG champion. S&P Global 2023 scored them 81 out of 100, which kept them in the Dow Jones Sustainability Index for 22 years. Isn't it a little strange? And also, they got an A- in climate change, water security, and forests assessment. This company is really good for the world. ISS ESG, well, they got prime status, indicating strong ESG performance. Sustainalytics scored 30.3, which is high risk, ranked 208 out of 574 in the tobacco industry, kind of average performance there. And Refinitiv in 2023 scored them number 91 out of 100, which is third best in the FTSE 100 and top in global food and tobacco. But you might be asking yourself, wait a minute, isn't ESG about environment and social, like, for instance, helping people? It's an ESG paradox. I always I rarely bring ESG into valuations because it's just so impossible. I mean, let's think about this paradox. Governments are penalizing BAT for harmful products, yet they're getting an impressive ESG performance. Government taxes tobacco to deter use, but BAT earns praise for its emission cuts. Smoking is condemned, yet BAT is celebrated for corporate responsibility. And BAT's harmful products are vilified, but sustainable packaging gets an applause. And finally, harming health, yet praised for protecting the planet. Now, this goes the same, whether it's Nestle, whether it's Pepsi, whether it's various different companies, Starbucks and the like. all of them have a harmful element in those cases, and that harmful element may be caffeine, it may be nicotine, it may be sugar, but they then go and get a great ESG score to make up for it. So do you really follow ESG? It's interesting. So BAT's strong brand image allows it to raise prices on premium products. Its investment in non-smoking alternatives drives growth, and ESG rewards for compliance to the scorecards. Well, does this strategy lead to a competitive advantage? That's the question. Is the company financially world-class? I use my world-class benchmarking scorecard to measure if a company has a competitive advantage. And I've developed this scorecard 10 years ago, and here's how we construct it. My team gathers the yearly and quarterly financial data of 26,000 companies worldwide. We then calculate each company's profitable growth score, which is a composite measure of both profitability and growth. After that, we rank the companies relative to sector peers of a similar size. And a decile ranking of 1 or 2 is financially world-class, while 10 is the worst. And we assess the company's performance over the prior 4 years and the past 12 months. So, is this company, BAT, financially world-class? Well, the answer to that is yes. It ranks as a 1 or 2 in 2023, as well as the past 12 months. It is now a financially world-class company. Now, revenue growth has been underperforming the global sector average in recent years. There was a 2017 surge when they bought the final stake in Reynolds America, but overall, growth has been relatively slow at the top line. So, does its strategy lead to a competitive advantage? I would say partially. BAT has shown portfolio growth in recent years according to our scorecard. So, what does the valuation look like? Let's go into that. What you see now is the share price chart, and we can see the share price has ranged between 25 and 35, and right now basically has shown some positive trend reversal with rising momentum and volatility. And recent trends show recovery with the short-term average surpassing the long-term. So it's been having a good run recently. Volume RSI spikes signal intense market activities during price swings, but also what we can see from the RSI spikes is that maybe it's not a great time to buy. It's already run quite a bit. Now, I use my FVMR methodology to determine the attractiveness of this company. I look at F in FVMR, which is fundamentals, things like net profit, return on assets. And we can look at this particular chart and show EBIT ROA is in line with 10,000 companies globally. Now, there was this huge charge. So if you look at net profit at the bottom line, you're going to see that it's a negative. But if we look at operating profit, we can see that it's about in line. The company's also been benefiting from cost-cutting initiatives and operational efficiencies. Now, the V in FVMR, we look at things like PE and price to book ratio, and then momentum is the M in FVMR, which is things like EPS growth and price change. Well, let's look at EPS growth. It's been about 5% from 2015 to 2023. That's 5 points above the global industry average. So it actually has had a couple of great years. Now, the net debt to equity and the beta are two things that I look for in relation to the R in FVMR, which stands for risk. So let's evaluate American Tobacco's potential using my cheat sheet for assessing any stock's attractiveness. Let's take a look at this abbreviated FVMR scorecard of British American Tobacco. Now, this data that you can see here shows, most important thing I want to highlight is that the price to book value is now 1.3 times price to book, almost at book value. That's pretty low compared to the average for this consumer staples, food, beverage, and tobacco sector, which is about 6 times price to book. I would argue that from a price to book basis, it looks interesting. Now, also consider let's look at that price to book basis for a second. This price to book of 1.3 basically shows us that the asset value has fallen. In other words, the book value has fallen. And the result of that is that it's closer to real numbers for the total assets and the equity of the company. So if it's at 1.3 times price to book and the assets are marked to market value, then I think you could say that it's very cheap at 1.3. So if the company can rev up its growth and continue what it's doing and maintain its profitability, I would argue that from a longer term perspective, it looks relatively inexpensive. So remember, you can click the link in the description to get this abbreviated FVMR scorecard for the world's top 500 companies. I update it every single week. Just drop your email in there and I'll send it to you every week. So let's recap. What does valuation look like? Well, it's relatively cheap on a 1.3 times price to book value after its asset write down. So let's wrap this up by looking at British American Tobacco. I told you that the balance sheet was up in smoke. That's because the company has written down almost a quarter of its asset value, but now the assets are at market value. And the result of that is that a 1.3 times price to book, I would argue, is no longer looking unreasonable. In fact, I would say that it looks pretty good. So that's it. Let me know in your comments in the comment section below what you think about this company.